So this is the opportunity which, with expectation, I request you to please deliver your chief guest address to the audience. Thank you very much, sir.
Thank you very much, Raghavendra, Vinodji, Sundar Raman, Nehal, Latika, and other dignitaries on the dais. First of all, I wanted to thank ANMI for taking this initiative with, of course, the help from BSc and others, for putting this together. The World Investor Week is extremely important for us. It's an opportunity for us to communicate with the marketplace as a whole and with investors. And it's an opportunity for all of us to learn together. So thank you for taking this initiative. And hopefully this will continue not just during this week, but going forward as well. Now, I want to ask the students, how many of you already invest in the markets? Raise your hands. A fair number. How many of you intend to invest in the markets going forward? How many of you think markets are very risky? Okay, so Prashant, when he came here first, he talked about this dilemma that we have, right? That mutual funds are subject to market risk. At the same time, mutual funds sahi hai. Now, let me tell you a little bit about SEBI, the Securities Exchange Board of India, and tie up with both this paradox. What is SEBI's role? SEBI's role, if you read the SEBI Act, which is a very boring act, don't try to read the whole document, it's a very long document. But the preamble to SEBI Act talks about three main pillars of SEBI's job. The first job is investor protection. So those of you who are investors, our job is to ensure you are protected. The second job is market development. And the third job is market regulation. Now, what do these three things mean? What this means is SEBI's role is to ensure capital formation. You know what that means? The cycle is as follows. Those who are investing in the markets, they bring in money looking for risk. They're looking for returns. That money is raised by people who want to create businesses. So you have investors and then you have people who are raising the money. If that money is raised to create businesses, which creates jobs, which creates savings, then you have more savings coming into the markets and it becomes a nice virtuous cycle. That's how capital markets are supposed to work. Take money from the investors who are looking for risk, give it to people who are looking to create jobs and businesses, and let the cycle continue. If the cycle goes too fast, there will be accidents. If it goes too slow, it will not go at all. It will just ludak ke gir jayega. So getting the speed right is extremely important. So the reality is, we require people to come in and become investors. There's no doubt. If our country has to do well, we need people like you to become investors. But we need you to come with your eyes open to the risks. If you come in thinking this is a beautiful, easy market where all you have to do is put money and you'll become multimillionaires in a week's time, then we will have a problem. So the reality is, the reason why we have mutual funds sahi hai and mutual funds are subject to market risk, as an investor, as a country, we need both the accelerator and the brake. This is a journey which requires both, not just one. Now, I'm going to talk about a few things. Raghavendra mentioned it's a very different audience. By the way, I have to warn you, before I joined SEBI, I was a teacher. and my job was to put half the class to sleep, particularly after lunchtime. So I'm going to use the same opportunity. I'm missing that. I'm missing going to students now. I'll first talk about something that you probably know, but it's still worth reiterating on investments. And that is the power of compounding. I'm sure you know this, but it's still worth reiterating. If you need a 1 crore rupee corpus when you're 60, and let's say you're 20 today, so you're 20, you have 40 years to go, and assume that the market is giving a 7% per annum return, how much do you have to start with today? Any guesses? It's a difficult question. It's about 6.5 lakh rupees. So if you start with 6.5 lakh rupees and the market grows at 7% per annum every year, you will end with 1 crore in 40 years' time. Okay? If you start not when you're 20, but when you're 30, which means you delay by 10 years, that 6.5 lakh rupees becomes 13 lakh rupees. If you wait until you're 40, that 13 lakhs becomes 26 lakhs. If you wait until you're 50, no prizes for guessing, 26 lakhs becomes 52 lakhs. So the more you wait to invest, the more you'll have to invest to get the corpus that you want, which is why one of the first rules of investment is try and start early. But here is a dilemma that every young person will go through. What about spending? Don't I have to enjoy life as well? Is it all about saving? So here is my other piece of advice to you. You have to spend. Don't only invest, please also spend. There are two reasons for this. One is, of course, you need to have a good time. Second is, if all of us say we will only save and not spend, the economy will not grow. We need consumption as well. Now, how do you then choose how much do you invest, given that you have to start early, and how much do you save? One rule of thumb, and this is where, by the way, good financial planning can help you. One rule of thumb is, you should spend, but make sure you're spending in a way that your standard of living will keep going up as you grow up. If you're spending too much now and having a very good time, and tomorrow if you have to come down, I can assure you that's a terrible feeling. So spend such that you are going to increase your spending over a period of time, increase your standard of living, and more importantly, when you retire, let's say at the age of 60, you should be able to maintain your last level of spending. And there are ways to plan for this. So choose the right mix of what you need to invest and what you need to spend to make sure your standard of living is going up and then stays at that level. You don't have to come down. Coming down is terrible. I have come down in my life. I can tell you it is terrible. You don't want to go through that. Now, the next concept I want to talk to you about, which is very important, and for a regulator particularly, is the concept of risk. Let me give you an example of how you feel risk. Supposing you had 1 crore of rupees invested in a benchmark of, basket of stocks, let's say Sensex, since we are at BSE, assume you had, invested 1 crore rupees in March 2017 on Sensex stocks. That value would have gone up over time. As of December 2019, it would have been about 1.35 crores. So you started with 1 crore, 1.35 crores, you're feeling nice and good. It's been a little bumpy, but it's grown. Then what happened in March 2020? We had COVID and we had the lockdown. That corpus on 23rd of March 2020 would have come down to 80 lakhs. So from 1.35 crores, there was a 40% fall in the value down to 80 lakhs. Now you can still think, oh, I started with 1 crore, it's actually 1 crore to 80 lakhs. That's not the way human beings think. They will say, I was worth 1.35 crores in December, my God, I've lost 40%. By the way, there was a happy ending to the story. By the time, after some ups and downs, March 2021, your portfolio would have been 1.6 crores. March 2024, it would have been worth 2.4 crores. Today, with all the volatility, it would be worth 2.75 crores. Now, some people will tell you, actually, close your eyes. Don't look at 80 lakhs. After all, you started with 1 crore. Now you're at 2.75 crores. What is your problem? That is very, very poor advice. The journey matters. What you feel during the journey matters. Not everybody can accept a 40% fall in your total wealth. I come from a relatively poor background. My father made the transition from poverty to middle class. I cannot take losses at a personal level. For me, volatility I cannot live with. This is the concept of volatility. If your returns are changing over a period of time, that is volatility. Only you know how much volatility you can accept. Now, how do you measure this volatility? We all understand returns. 20% returns, 30% returns. How do you understand risk? So do me a favor. If you have to, a lot of people advise you to do research. If you want to become good investors, understand the concept of volatility. It's not an easy measure. It's a mathematical measure, but understand it. This is where option markets are very useful. They give you a good measure of how much risk is there in a particular stock by telling you the volatility. Nifty or BSE Sensex typically has a volatility of 15% or so. Individual stocks have 30%, 35% in Sensex, for instance. During that time, when COVID hit, volatility went up beyond 50%. So if your threshold is 30%, at time of COVID, you're sitting on a market which is much more volatile than you're used to. So knowing what your risk acceptance is very, very important. Now, how do you manage risk? First is, as I said, you have to know what your risk appetite is. Second is, let me give you the guru mantra. We are all told, and you're all students, you must have done economics, that there is no such thing as a free lunch. You must have heard that phrase. There is something which comes the closest to being a free lunch, and that is the power of diversification. This is not my saying. This is a person called Harry Markowitz, who's the father of modern portfolio theory. He said this. You know what this means? Why is it that Sensex has a volatility of 15%, whereas individual stocks of Sensex has 30 or 35% volatility? Because Sensex is diversified already, right? So the more you diversify, and not just across stocks, across real estate, across gold, across commodities, across currencies, across all of this, the better your returns and the lower your risk. If your risk acceptance is 25%, do not choose a stock which has 25% volatility and invest 100% in it. Choose a basket which gives you a volatility of 25%. The returns will be far higher. Also, once you've chosen a portfolio, you have to rebalance to bring it back to that periodically. So if you choose 60% equity and 40% debt, after 1 year, you have to rebalance to ensure you're still there at 60-40. Now, I know this is complicated. My request to you, if you have to educate yourself, please spend some time on understanding risk. You will do yourself a favor. Third part is trading versus investing. The two are not the same, and you know that. The more you trade as an individual, the less you make. This is true as an average. There will be exceptions. There will be people who say, I traded so much, I made so much money. But for an average, this is true. By the way, there was a lovely research done by somebody called Barber and Odeon, which said that women make more money than men as investors. This is not my research, this is their research. You know how they found this? Their explanation? Men are overconfident. They think they know. So therefore they trade more and more. Therefore they lose more. Therefore they make less. Women are less confident. Therefore they have lots of doubts. So they don't trade in and out. So they make more. So reality is that more you trade, and we find this in India as well. In futures and options over the last 3 years, 93% of individuals who traded lost. Only 7% of individuals made money. In intraday trading in stocks, 70% of the people who traded intraday lost. Only 30% made some small amount of money. That doesn't mean you should not trade. That does not mean you should not speculate. It is your hard-earned money. You do what you have to do. But be aware of the risks, is all we are saying. If you want an investment strategy that is the best designed to give you returns over a period of time, choose your asset allocation, diversify, maintain that asset allocation, keep it for a long period of time. That is your best chance of getting long-term steady returns. Not trading in and out, not timing the market, aaj niche kharido, kal upar hai, bech do. That's not the way normal people make. Again, I'm not giving you advice. Do what you want, but be aware of the risks and what the returns are. Final piece. I said this a couple of days back. All roads lead to Rome, but be careful who takes you there. You heard Sundar Raman say how bright our future is as a country. There is no doubt we have immense economic potential. We should do well in our markets, but be extremely careful about who advises you on the journey. If somebody has the guru mantra to make you a crorepati starting with 1 lakh rupees over a period of 1 year, why would that person sell that secret to you for 4,999 rupees? Why is it that people are giving you this training advice of, I'll tell you how to become millionaires and multimillionaires, when they could spend all that time making that money for themselves? Ask the question, why is something being sold to me? Ask the question, what is in it for that person? Where is he or she getting a cut from? Is it by becoming a YouTube influencer you're getting a lot of money? Or is it somebody else who's paying you for doing this? Choose SEBI registered advisors, brokers, intermediaries as your companions, just as you would choose a medical doctor rather than choosing a quack. Right? That doesn't mean doctors can't make mistakes, but at least you have a redressal mechanism for handling such situations. So be very, very careful who takes you there, who's your accompaniment, and use for financial planning as well. Just as you would pay for a tax agent or for a chartered accountant or a lawyer, please pay for financial advice as well. It's not a bad thing. It's a very complicated area. I'm going to stop here because I already see half of you are sleeping. But very quickly to recapitulate, we need young people like you to be invested in markets, but please be aware of the risks. Please come with your eyes open. Do not expect that this is a one-way street which will make you lots of money in a smooth ride. There will be ups and downs. Take your decisions yourself. Take the advice from good people who are registered with SEBI, but take your final calls and be ready for the risk that you're actually accepting. Be responsible, knowledgeable, knowing investors, and help the country grow, help capital markets grow. Thank you very much for this opportunity once again.
Thank you very much, sir, for your kind words to the audience. And it's beyond the expectation what they came here. They came here to plan for tomorrow or day after, but you have given them a lifelong, up to retirement, the tip to survive. This is how the savings will add to your life. And this is the audience where you all here hearing to SEBI, WTM whole-time member. In the hierarchy, he is the second in command, and he is the one who is the author of all your development regulations which are coming into you to safeguard you. This is where the power of SEBI, where we are protected, and this is the retail saving our retail money is now the motto for which last 2 months they are working hard. Some of the statistics have been thrown to you. You can imagine the protection is 9 out of 10 are losing money. It is what has been found out from the greatest research, what they have done. So, sir, it is not only the best, sir, my audience got all the great ideas from you and the investor awareness. And we thank you also for accepting our invitation, sir. And it is kind of gathering for this type of audience is very difficult to get. And ANMI has been nurturing all these ideas for long, and all the dignitaries on the dais very remotely accessible today are become accessible to the proximately to my students. This is one of the best events which ANMI could do in past couple of years. This is the one of the best I have done. So coming to the one of the best